Hello, and welcome back to Boni's Life, your weekly dose of crypto clarity in a world of digital chaos. I'm your host, Boni, and this week we're diving deep into the turbulent waters of the crypto market to chart a course for the coming week. Last Friday, September 6th, at exactly 8:30 a.m. Eastern Time, the Bureau of Labor Statistics released the August jobs report. And to put it mildly, it was a complete disaster. The US economy added only 22,000 jobs, a far cry from the 76,500 that economists were expecting. That's a miss of over 70%, folks. But it gets worse. The unemployment rate ticked up to 4.3%, the highest it's been since October 2021, nearly 4 years ago. Now, let's put this in perspective. The last time we saw unemployment at this level, we were still dealing with the aftermath of the COVID-19 pandemic. The labor force participation rate also declined to 62.7%, down from 62.9% in July. This suggests that people aren't just losing jobs, they're giving up looking for work altogether. That's a classic sign of economic distress. The average hourly earnings, which is a key inflation indicator, rose by only 0.2% month over month, below the expected 0.3%. Year over year, wage growth slowed to 3.8%, down from 4.1% in July. This is significant because it shows that inflationary pressures from wages are cooling, which gives the Federal Reserve more room to cut interest rates. But here's where it gets really interesting. The jobs report also showed that the previous month's data was revised downward. July's job gains were revised down from 114,000 to just 89,000. June was revised down from 179,000 to 118,000. That's a combined downward revision of 81,000 jobs. When you add that to August's disappointing number, we're looking at a labor market that's significantly weaker than anyone anticipated. Now, why should we care about this? Because it's a huge signal to the Federal Reserve. The Fed has a dual mandate: to keep inflation in check and to maintain maximum employment. With the labor market showing clear signs of weakness, and with inflation already cooling from its peaks, the pressure is on for the Fed to cut interest rates to stimulate the economy. And the market agrees. Before the jobs report, there was about a 70% chance of a rate cut at the Fed's next meeting. After the report, that probability shot up to 100%. That's right, a sure thing. The only question now is how much they'll cut. The smart money is on a 25 basis point cut, with about 89% probability. But there's even an 11% chance of a more aggressive 50 basis point cut, which would be the first time since the early days of the pandemic that the Fed has cut rates by half a percentage point. So, what does this mean for crypto? Historically, lower interest rates have been a major tailwind for crypto. When it's cheaper to borrow money, investors are more willing to take on risk, and that often means more money flowing into assets like Bitcoin and Ethereum. It's like a rising tide that lifts all boats, and crypto is a boat that loves to ride the waves. But it's not all smooth sailing. A weak jobs report also raises the specter of a recession, which could lead to a broader market downturn. The yield curve, which has been inverted for months, is starting to steepen, which historically has been a precursor to economic downturns. The 10-year Treasury yield fell to 3.91% after the jobs report, down from over 4.3% just a few weeks ago. This flight to safety in bonds suggests that investors are getting nervous about the economic outlook. Now, let's turn our attention to the week ahead, because it's absolutely packed with events that could move the market. And I mean packed. We've got economic data, crypto conferences, token unlocks, and regulatory developments all converging in what could be a perfect storm of volatility. First up on Wednesday, September 11th, at exactly 8:30 a.m. Eastern Time, we get the latest consumer price index data for August. This is absolutely crucial because it will give us a better idea of where inflation is heading. The consensus estimate is for headline CPI to come in at 2.6% year over year, down from 2.9% in July. Core CPI, which excludes food and energy, is expected to remain steady at 3.2%. Now, here's why this matters so much. If the CPI comes in lower than expected, it will give the Fed even more ammunition to cut rates aggressively. We could see the probability of a 50 basis point cut increase significantly. But if inflation comes in hotter than expected, it could throw a wrench in the works and force the Fed to be more cautious. The market is particularly focused on shelter costs, which make up about 1/3 of the CPI basket. Shelter inflation has been sticky, running at around 5.1% year over year. But there are signs that it's starting to cool, with new lease rates declining in many major metropolitan areas. If we see a significant decline in shelter inflation, it could be the catalyst for a more aggressive Fed response. Then, on Tuesday and Wednesday of next week, September 16th and 17th, we have the main event, the Federal Reserve's Federal Open Market Committee meeting. The meeting starts at 2 p.m. Eastern Time on Tuesday and concludes at 2 p.m. Eastern Time on Wednesday with the rate announcement. As we discussed, a rate cut is already priced in, but we'll be listening closely to Jerome Powell's press conference at 2:30 p.m. Eastern Time on Wednesday for clues about the Fed's future plans. Powell's press conference is always a market-moving event. Traders will be passing every word for hints about the Fed's dot plot, which shows where individual Fed members expect interest rates to be in the future. The current dot plot suggests rates could fall to around 4.5% by the end of 2025. But if the economic data continues to weaken, we could see those projections revised lower. Any hint of a more aggressive easing cycle could send crypto soaring. Remember, the last time the Fed embarked on a significant easing cycle was in 2019, and Bitcoin rallied from around $3,200 to over $13,000 in just a few months. Of course, past performance doesn't guarantee future results, but it gives you an idea of how sensitive crypto can be to monetary policy changes. Starting tomorrow, Monday, September 9th, Boston Blockchain Week kicks off at Kilroy Square in Quincy, Massachusetts. This is one of the biggest blockchain conferences on the East Coast, running through Friday, September 13th. The main stage events are on September 9th through 11th, with over 5,000 attendees expected. This conference has historically been a launching pad for major announcements, particularly around institutional adoption and regulatory clarity. Last year's Boston Blockchain Week saw announcements from major financial institutions about their crypto custody services, and we could see similar developments this year. With the recent approval of Bitcoin and Ethereum ETFs, there's a lot of institutional interest in expanding crypto services. Keep an eye out for announcements from traditional financial firms about new crypto products or partnerships. Then, on Tuesday, September 10th, we have Bitcoin Amsterdam, which is one of the premier Bitcoin-only conferences in Europe. This conference focuses exclusively on Bitcoin, covering everything from Lightning Network developments to mining innovations. The conference runs for 2 days and typically attracts some of the most influential voices in the Bitcoin community. What makes Bitcoin Amsterdam particularly interesting this year is the timing. With Bitcoin trading near all-time highs and institutional adoption accelerating, we could see some major announcements about Bitcoin infrastructure developments. There's been a lot of buzz about potential Lightning Network integrations with major payment processors, and this conference would be the perfect venue for such announcements. But the big one is ETH Tokyo, which kicks off on Thursday, September 12th, and runs through Sunday, September 15th. The main conference day is Friday, September 12th, at the United Nations University in Tokyo. This is one of the most important Ethereum ecosystem events of the year, and it's happening at a crucial time for Ethereum. ETH Tokyo typically focuses on Layer 2 scaling solutions, DeFi innovations, and institutional adoption of Ethereum-based technologies. With Ethereum's recent upgrades and the growing popularity of Layer 2 solutions like Arbitrum and Polygon, we could see some major announcements about scalability improvements or new DeFi protocols. The timing is particularly significant because we're approaching the 3rd anniversary of the Ethereum merge on September 15th. The merge was when Ethereum transitioned from proof of work to proof of stake, reducing its energy consumption by over 99%. This anniversary could be a catalyst for renewed interest in Ethereum, especially given the environmental concerns that have plagued crypto in recent years. Now let's talk about something that could create some short-term headwinds: token unlocks. We have a massive wave of token unlocks this week, with over $4.5 billion worth of tokens being released into circulation. This is one of the largest unlock events we've seen all year, and it could create significant selling pressure. Starting Monday, September 9th, we have the SUI token unlock. Approximately $184 million worth of SUI tokens will be unlocked, representing about 2.8% of the total circulating supply. SUI is a layer 1 blockchain that's been gaining traction in the DeFi space, but this unlock could put pressure on the token price in the short term. On Thursday, September 12th, we have the Ethena unlock. About $60 million worth of ENA tokens will be released, which is significant given Ethena's relatively small market cap. Ethena is a synthetic dollar protocol that's been gaining attention in the DeFi space, but this unlock represents a substantial portion of the circulating supply. But the big one is on Sunday, September 15th, when we have multiple major unlocks happening simultaneously. Arbitrum will unlock approximately $45 million worth of RB tokens. Aptos will unlock $35 million worth of APT tokens, and Layer 0 will unlock $25 million worth of ZRO tokens. That's $105 million in potential selling pressure, all hitting the market on the same day. Now, token unlocks don't always result in immediate selling pressure. Many of these tokens are held by long-term investors, team members, or institutional partners who may not be looking to sell immediately. But the market often reacts negatively to unlock events, especially when they're as large as these ones. The key thing to watch is the price action in the days leading up to these unlocks. If we see significant selling pressure beforehand, it could indicate that holders are trying to get ahead of the unlock. Conversely, if prices hold steady or even rally into the unlock, it could suggest that the market has already priced in the potential selling pressure. Speaking of Ethereum, let's talk about the upcoming third anniversary of the merge on Sunday, September 15th. This is a huge milestone for the Ethereum ecosystem, and it's worth reflecting on how far we've come. The merge was one of the most significant technical achievements in crypto history, successfully transitioning the world's second largest blockchain from an energy-intensive proof-of-work consensus mechanism to a more efficient proof-of-stake system. Since the merge, Ethereum's energy consumption has dropped by over 99%, making it one of the most environmentally friendly major blockchains. The network has also become deflationary, with more ETH being banned than issued in many periods. This has led to a reduction in the total supply of ETH, which is fundamentally bullish for the token's long-term value proposition. The anniversary could be a catalyst for renewed interest in Ethereum, especially given the recent success of Ethereum-based Layer 2 solutions. Networks like Arbitrum, Optimism, and Polygon have seen explosive growth in transaction volume and total value locked. This scaling ecosystem makes Ethereum more attractive for both developers and users, potentially driving more demand for ETH. We might also see some announcements related to Ethereum's roadmap during the anniversary period. The Ethereum Foundation has been working on several major upgrades, including sharding and further improvements to the consensus mechanism. Any updates on these developments could be market moving. Now, let's shift gears and talk about some regulatory developments that could impact the market. On Wednesday, September 11th, the Securities and Exchange Commission is expected to hold a discussion about digital asset rules. This follows the SEC's recent inclusion of crypto rules in its rulemaking agenda for the first time, which many see as a positive development for regulatory clarity. The discussion is expected to focus on custody rules for digital assets, market structure regulations, and potential frameworks for DeFi protocols. While we're not expecting any immediate rule changes, this discussion could provide important insights into the SEC's thinking on crypto regulation. Regulatory clarity has been one of the biggest overhangs on the crypto market, so any positive developments on this front could be significant catalysts. The recent approval of Bitcoin and Ethereum ETFs has already shown that regulators are becoming more comfortable with crypto, and further clarity could open the floodgates for institutional adoption. On Friday, September 13th, we're expecting an announcement from a major US bank about expanded crypto custody services. While I can't name the bank due to confidentiality agreements, this is expected to be a significant development for institutional adoption. The bank is reportedly planning to offer custody services for Bitcoin, Ethereum, and several other major cryptocurrencies to its high net worth clients. This follows a trend we've been seeing throughout 2025, with traditional financial institutions increasingly embracing crypto. JP Morgan Chase, Bank of America, and Wells Fargo have all expanded their crypto services this year, and this latest announcement could accelerate that trend. Let's also talk about some global economic context that could impact crypto markets. On Thursday, September 12th, the European Central Bank is holding its monetary policy meeting. While the ECB is not expected to cut rates at this meeting, any dovish commentary could impact global liquidity conditions and, by extension, crypto markets. The ECB has been more hawkish than the Federal Reserve in recent months, but there are signs that European economic growth is slowing. If ECB President Christine Lagarde signals that rate cuts could be coming in the near future, it could add to the global monetary easing narrative that's been so bullish for crypto. On Friday, September 14th, we get the University of Michigan Consumer Sentiment Survey, which is an important gauge of economic confidence. Consumer sentiment has been volatile in recent months, reflecting uncertainty about the economic outlook. A strong reading could suggest that consumers are optimistic despite the weak jobs data, while a weak reading could reinforce recession fears. Now, let's get to the technical analysis because the charts are telling us some interesting stories. As always, we'll start with Bitcoin, the king of crypto. Bitcoin has been in a period of consolidation for the past 2 weeks, trading in a range between $107,000 and $113,000. This consolidation is actually quite healthy after the strong rally we saw in August, when Bitcoin gained over 15%. The relative strength index is currently at 52, right in neutral territory, which suggests that the market is neither overbought nor oversold. The key support level to watch is $107,000, which has held on 3 separate occasions over the past 2 weeks. This level coincides with the 20-day moving average, which is currently trending upward. A break below this level could open the door to a deeper correction toward $102,000, which is the 50-day moving average. On the upside, the key resistance level is $113,000, which has capped rallies on 4 occasions. A break above this level could signal the start of the next leg up, with the next major resistance at $118,000, which is the 161.8% Fibonacci extension of the July correction. The moving averages are starting to converge, with the 20-day moving average at $108,500 and the 50-day moving average at $102,000. This convergence often precedes a significant move in either direction. Given the bullish macro backdrop with potential Fed rate cuts, I'm leaning toward a resolution to the upside, but will need to see confirmation with a break above $113,000. The volume profile is also interesting. We've seen declining volume during this consolidation period, which is typical of a healthy correction. However, we'll want to see volume pick up on any breakout attempt to confirm the move. From a longer-term perspective, Bitcoin remains in a strong uptrend. The weekly chart shows a clear ascending triangle pattern, with higher lows and a flat resistance line at $113,000. This is typically a bullish continuation pattern, suggesting that the long-term trend remains intact. Now let's look at Ethereum, which has been showing some relative weakness compared to Bitcoin. Ethereum has been trading in a wider range than Bitcoin, between $4,000 and $4,500. The price is currently hovering just above the $4,200 level, which has provided support on multiple occasions. The RSI is at 32, which is approaching oversold territory and suggests that a bounce could be on the horizon. The key support level to watch is $4,000, which is a major psychological level and also coincides with the 50-day moving average. A break below this level could signal further weakness, with the next support at $3,750, which is the 200-day moving average. On the upside, the key resistance is at $4,500, which has capped rallies on 3 occasions. A break above this level could be a very bullish signal, especially with the merge anniversary coming up. The next major resistance above that would be at $4,800, which is the high from early August. The Ethereum/Bitcoin ratio is also worth watching. It's currently at 0.037, near the lower end of its recent range. This suggests that Ethereum has been underperforming Bitcoin, but it also means there could be room for outperformance if sentiment toward Ethereum improves. The upcoming merge anniversary could be a catalyst for Ethereum to outperform. Historically, Ethereum has shown strength around major milestones and upgrades. The combination of the anniversary, potential announcements at ETH Tokyo, and the overall bullish macro environment could create a perfect storm for Ethereum. Let's also look at some of the major altcoins because they often provide early signals of market direction. Solana has been one of the strongest performers recently, up over 25% in the past month. It's currently trading at $142, just below its recent high of $148. The strength in Solana is likely due to continued growth in its DeFi ecosystem and increasing institutional interest. The key support for Solana is at $135, while resistance is at $148. Cardano has been lagging, down about 8% over the past month. It's currently trading at 43 cents, struggling to break above the 36 cents resistance level. Cardano has been hurt by concerns about its development progress and competition from other smart contract platforms. Support is at 32 cents. Polygon has been showing strength ahead of its upcoming token unlock. Despite the potential selling pressure, the token is up 12% over the past 2 weeks, suggesting that the market may have already priced in the unlock. Key resistance is at $0.58, while support is at $0.52. Now let's talk trading strategies. How do we navigate this complex environment with so many moving parts? For the bulls, the current consolidation in Bitcoin and Ethereum presents a great opportunity to accumulate. The combination of potential Fed rate cuts, improving regulatory clarity, and strong technical setups suggests that the path of least resistance is higher. Look for a bounce off the key support levels I mentioned and consider setting stop losses below the recent lows. A break above resistance in either Bitcoin or Ethereum could be a signal to add to positions. The key levels to watch for Bitcoin are a break above $113,000 for continuation higher, or a break below $107,000 for potential weakness. For Ethereum, watch for a break above $4,500 for bullish momentum, or a break below $4,000 for potential further downside. For those looking to trade the macro environment, consider that a lower than expected CPI reading on Wednesday could be a significant catalyst for crypto. If CPI comes in at 2.4% or lower, we could see an immediate rally in risk assets, including crypto. Conversely, a reading above 2.8% could cause some short-term weakness. For the bears, the token unlocks could provide some short-term trading opportunities. Look for weakness in the specific tokens that are being unlocked, particularly SUI, Ethena, Arbitrum, Aptos, and Layer 0. Consider shorting these tokens on any strength leading up to the unlock dates, but be careful about timing and use tight stop losses. The key thing to remember about trading token unlocks is that the selling pressure often comes before the actual unlock date, as holders try to get ahead of the event. So if you're looking to short these tokens, you might want to do it sooner rather than later. For those of you who prefer a more conservative approach, a range trading strategy could be the way to go. Buy at the bottom of the range and sell at the top. For Bitcoin, that means buying near $107,000 and selling near $113,000. For Ethereum, buy near $4,000 and sell near $4,500. It's a less risky way to play a sideways market, but make sure to use stop losses in case of a breakout. Another strategy to consider is the Fed trade. If you believe that the Fed will cut rates aggressively, consider positioning in assets that benefit most from lower rates. Historically, this has included growth stocks and risk assets like crypto. You could also consider shorting the dollar, as rate cuts typically weaken the currency. But remember, no matter what your strategy is, always do your own research, use appropriate position sizing, and never invest more than you can afford to lose. The crypto market is incredibly volatile, and even the best analysis can be wrong. Let's also talk about some longer-term themes that could impact crypto markets beyond this week. The institutional adoption story continues to gain momentum, with more traditional financial institutions offering crypto services to their clients. This trend is likely to accelerate as regulatory clarity improves and as crypto infrastructure becomes more robust. The development of central bank digital currencies is another theme to watch. Several major economies are piloting CBDCs, and their eventual rollout could have significant implications for the crypto ecosystem. While CBDCs could compete with some crypto use cases, they could also legitimize digital currencies and drive broader adoption. The environmental sustainability of crypto continues to be a focus, especially as ESG investing becomes more important to institutional investors. Ethereum's successful transition to proof of stake has been a major positive development, and other blockchains are following suit. This trend toward more sustainable consensus mechanisms could be a long-term tailwind for crypto adoption. As we wrap up today's analysis, I want to emphasize that we're at a potentially pivotal moment for crypto markets. The combination of weakening economic data, potential Fed rate cuts, improving regulatory clarity, and continued institutional adoption creates a compelling backdrop for crypto assets. However, we also face some near-term headwinds, including significant token unlocks and ongoing macroeconomic uncertainty. The key is to stay flexible and adapt to changing conditions while keeping an eye on the longer-term trends that are driving crypto adoption. The events of this week, particularly the CPI data on Wednesday and the Fed meeting next week, could set the tone for crypto markets for the remainder of 2025. If the Fed embarks on an aggressive easing cycle, we could see crypto enter a new bull phase. But if economic conditions deteriorate rapidly, we could see some short-term volatility. My base case remains bullish for crypto over the medium to long term, but I expect continued volatility in the near term as markets digest the flood of information coming this week. And that's all the time we have for this week's deep dive. I hope you found this analysis helpful and comprehensive. As always, I'd love to hear your thoughts in the comments below. What are your predictions for the coming week? How are you positioning your portfolio for the potential Fed rate cuts? What strategies are you using to navigate the token unlocks? Let me know your thoughts. If you enjoyed this in-depth analysis, be sure to hit that like button and subscribe to the channel for more comprehensive crypto content. And don't forget to ring that notification bell so you never miss an episode. We've got some exciting content planned for the coming weeks, including interviews with some major players in the crypto space. Until next time, stay safe, trade smart, and remember that in crypto, as in life, knowledge is your most valuable asset. I'll see you in the next one. Before I sign off, let me share some additional insights that could be crucial for your trading decisions this week. The correlation between crypto and traditional markets has been strengthening recently, with Bitcoin showing a 0.73 correlation with the Nasdaq over the past 30 days. This means that crypto is increasingly moving in tandem with tech stocks, which makes the Fed's decision even more important for our space. I also want to highlight some emerging trends that aren't getting enough attention. The growth of Bitcoin Layer 2 solutions has been remarkable, with the Lightning Network now processing over $200 million in monthly volume. This infrastructure development is crucial for Bitcoin's long-term scalability and adoption as a medium of exchange, not just a store of value. On the institutional front, we're seeing pension funds and sovereign wealth funds quietly accumulating crypto positions. While these moves aren't always public, the flow data suggests that institutional demand remains robust despite recent market volatility. This institutional backbone provides important support for crypto prices during periods of uncertainty. The geopolitical landscape is also worth monitoring. With ongoing tensions in various regions and concerns about currency debasement, Bitcoin's role as a neutral, borderless asset becomes increasingly relevant. We've seen this play out in countries experiencing currency crises, where Bitcoin adoption has surged as a hedge against local currency volatility. Looking ahead to the fourth quarter of 2025, several catalysts could drive crypto markets higher. The potential approval of additional crypto ETFs, continued institutional adoption, and possible regulatory clarity from major jurisdictions all point to a constructive environment for digital assets. Remember, successful crypto investing requires patience, discipline, and a long-term perspective. While short-term volatility can be challenging, the underlying trends driving crypto adoption remain intact and continue to strengthen over time. Stay informed, stay disciplined, and most importantly, stay safe out there in the crypto markets. This has been Boni, and I'll catch you next week for another deep dive into the world of digital assets.